So choosing which index fund or index you want to invest in can be a bit opinionated. What I mean by this is that even though I recommend the S&P 500, someone else might recommend something different, and honestly, I wouldn't say they're completely wrong either. Some people might also recommend investing in a few different index funds, but for me, I want to keep this as simple as possible and show you what I would do if I started investing today. In different periods of history, different indexes have performed the best. But we really can't guarantee that what has happened in the past is going to continue happening moving forward. Another index that I've invested in and done well for me in the past is the NASDAQ 100. Why did it do well? Well, the NASDAQ 100 is an index that tracks 100 of the largest non-financial companies listed on the NASDAQ stock exchange, which is a stock exchange in the US. Stock exchanges are just places where the buying and selling of stocks happen. Each country likely has its own, but US is one of the biggest countries financially, thus the NASDAQ stock exchange is one of the biggest stock exchanges in the world. Since the NASDAQ 100 has 100 biggest companies, it's heavily weighted towards big tech companies like Nvidia, Amazon, Meta, Google, Microsoft. You get the point. Those stocks have performed extremely well in the past few years, so the NASDAQ 100 index, which tracks these stocks, has also performed pretty well. But there is no guarantee that this is going to continue in the future. The S&P 500 is an index that pretty much tracks the 500 biggest or top performing companies in the US. It does contain a lot of stocks that are in the NASDAQ 100, but since it's 500 companies, it's also a bit more diversified and contains companies from various different sectors and industries. Based on all the research I've done, all the other people I've listened to talk about how to invest, I think there's a general consensus that investing in the S&P 500 is a great way to go. But to reiterate, there are also other options as well, which can also be considered equally correct. Sticking to what a lot of people do and sticking to one index, in my personal opinion, is a great and simple way to approach investing. Now, the biggest pushback or thought people have when they hear invest in index funds is that, oh, you can't make a lot of money doing that. Now, in my opinion, that is completely not true. Our goal with investing is not to convert $1,000 to $10,000 in a year or anything like that. If that's your goal, then you have a completely wrong understanding of the purpose of investing. You should just go to the casino and gamble to make money fast. Investing is very similar to saving in a sense. It's a slow process, and your bank account or your investment account will slowly grow in value. The only and the most important difference between saving and investing is that when you're saving, your money actually loses value over time due to inflation. But when investing, your money gains in value and will keep growing over time. Every year, things get more and more expensive due to inflation. So the $10 you saved 10 years ago is not able to buy the same amount of stuff now. Like $10 might have gotten you 50 apples 10 years ago, but now you can only buy 20 apples with $10. Since the purchasing power or how much you're able to buy with your money has gone down due to inflation, saving money actually means you're losing money. So that's why it's so important to invest the money you save so the money can grow over time. When you invest in an index fund like the S&P 500, you can actually grow your money by quite a bit. At the time of recording this video, the S&P 500 has delivered an average annual return of over 10% since 1957. But when adjusted for inflation, the real return drops to 6.47%. No one really thinks about real returns. I'm sure you just care about how much money you have in your bank account, and that is the 10.33% that I just mentioned. Real returns kind of add to the fact that $1 million 20 years ago is not the same $1 million today, since everything's more expensive. So thus your real rate of return, or how much your money is actually growing and how much more stuff you're actually able to buy, has gone up only 6.47% per year. But back to what I was saying, most people just think about the 10% return number. A return of 10% per year would mean that if you invested $100 today, it will become $110 next year and $121 the year after that, all the way to about $260 in 10 years. Now, imagine you invested $10,000 instead. That would become $26,000. Hopefully you get the point I'm trying to make. Investing is totally worth it. One thing I do want to mention is that actual investment growth is not linear like this. The stock market goes up and down, but over the long term, the average return is around 10%. If you look at the S&P 500 graph over the past 5 years, in 2022, the return from the S&P 500 was actually negative and well below 10%. But in 2021 and 2023, the returns were way above 10%. Over time, this averages out to get the result of an average 10% return per year. Investing in index funds like the S&P 500 reduces the risk of investing in the stock market because it allows for diversification. But it still gives you very good returns that can grow your money by quite a bit in the long run. One common misconception about indexes is that the stocks in the index are weighted equally. Like if I told you the S&P 500 tracks stocks of the 500 biggest US companies, you would think that each stock or company has an equal contribution to this index. But that's definitely not the case. If you look at the S&P 500's composition on the screen right here, you would see that there's still more weight or more emphasis on big tech stocks. So if the tech industry goes down, the S&P 500 is likely to go down. But if the tech industry stocks go up, maybe because of an AI revolution, then the S&P 500 is also going to benefit off of that and go up as well. That was just an extra piece of information so you feel a bit more confident about index funds and specifically the S&P 500, which we'll be investing into.